Hi everyone, and welcome back to the channel. Today, we are getting into JEPI, or what many call JEPI. They give out an amazing 11% return with a very low expense ratio, especially for an actively managed fund. But what are some red flags that we should be looking at with this fund, and what should we know about it before we invest in it? Well, let's get into what JEPI is, how they provide that 11% return, and let's see if there's any red flags that we should be aware of before we invest. Let's get into it. JEPI is the JP Morgan Equity Premium Income ETF, and its inception was on May 20th of 2020, so it certainly isn't an old ETF. And its main goal is to make income for people month after month. It does this by providing a 12-month rolling dividend of 11.31% and a 9.59% 30-day SEC yield. This is crazy high, and it's no wonder that this particular ETF has gotten so much attention lately. The price of this ETF has not changed a lot since its inception, and that goes true for the last 3 and 12-month period as well. Its top investments include Progressive, MasterCard, Coke, Pepsi, and Visa, which are all pretty great stocks. But none of them can really explain how this ETF is able to provide such a high dividend yield. This ETF is actually able to provide those high dividend yields because of the volatility in the current market, and they do this through ELNs. And the first thing I think of is, what is an ELN? Well, they're kind of like covered calls. But let's see what Investopedia has to say about that. An ELN is an equity-linked note, and it's an investment product that combines a fixed income investment with additional potential returns that are tied to the performance of equities. That probably wasn't the easiest to understand, but let's watch this very short video on covered calls that I made so you can get an understanding of how that works, and then I'll explain how that kind of works over for ELNs. Selling covered calls is a strategy where you sell a call option on 100 shares that you already own. By selling this call option to someone, you collect a premium, which is the price the buyer paid for the call. If the price stays below the chosen strike price of your covered call, you keep the premium and your shares. If the price rises above the chosen strike price, your shares are sold at the strike price, which generally is for a profit, assuming you chose a strike price that is higher than the value of your shares when you sold that covered call. It is a strategy that offers some downside protection while generating additional income through a premium. So after watching that, hopefully you understand what covered calls are. And this is basically what JEPI is trying to do, except with something called an ELN. And it's really just a complex covered call, so you have the basic idea down now. They take advantage of this covered call strategy by selling the premiums on their contracts. And they're making a lot of money because the market is so volatile right now. They can only do this though when the market is volatile. Whenever the market starts to get calmer and more consistent, they won't be able to make those high returns that they currently are. And here's a perfect example of that. Let's look at this stock, and it's AT&T. They're a stock that really doesn't have a lot of change up and down, so their options really aren't worth that much money. But on the other hand, we can take a stock like Tesla, where their stock is very volatile, and you'll see that their options are worth a lot of money. And that's because you never know where that stock's going to go. On the other hand, you can pretty much guarantee AT&T stock is not going to have a huge upswing or a huge downswing other than maybe on earnings. But Tesla stock, you truly never know. And that's why those premiums are worth so much money. With ELNs and the high market volatility, JEPI is able to make a lot of money on these premiums, as long as they don't get into contracts where they're going to be exercised consistently. And they're not doing that right now. They're doing a really great job of getting this premium month after month. And that's how they're providing a consistent dividend income for you or any other investor that invests in their fund. But while this seems really great right now and they're doing a good job, let's take a look at some of the red flags and why we should be careful before we just invest into this fund. Number one, these high returns are not likely to stay. With ELNs, the average return is between 5 and 8%. And right now, JEPI is giving an 11% return, which is great, right? But it's really not going to last that long. As the market volatility starts to come down and things start to mellow out, the market is going to pay less money for these premiums on these contracts. And that's just because it's less likely that the market's going to shoot up really high or go down very deeply. It just depends on what the market volatility is, and that's how much money you're going to get for these contracts. So right now, they're getting a lot, but I don't expect that to last for a long time. Number two, taxes matter a lot in a fund like this. If you're using a tax advantage account, then you don't need to worry about this. But if you're not, and this is just a normal brokerage account for you, then you need to understand that when ELNs are used, only some of that dividend income can actually qualify as dividend income on your taxes. So you need to be aware of that, and if you're not using a tax advantage account, this might not be the best investment for you. Number 3, we need to look at the expense ratio. And while it isn't that high, we need to pay attention to what return you're getting for paying that higher expense ratio. Right now, the current expense ratio is 0.35%. That means for every $10,000 you invest, you're going to pay $35 in expenses. And while that's fine when the fund is returning an 11% return, it's not that great when you're going to get the average 5 to 8%. With that expense ratio, you're not beating the market, so why would you be paying that? It just doesn't make a lot of sense to me. At the end of the day, I don't think this is a bad fund at all, especially when the market is this volatile. On the other hand, when the market starts to cool down and things mellow out, I don't think this is the fund for you. So if you're willing to make your money here while you can and then move it, I think it's a great opportunity. You just don't want to get stuck with that high expense ratio in a fund that's only getting 5 to 8% returns. Be sure to leave a comment below what you'll be doing with your money. Also, don't forget to like and consider subscribing to the channel if you enjoy content like this. Otherwise, I'll catch you in the next one.